Mr. Siddhartha. So the webinar is not started. We are just starting. Kindly request everyone to please wait. So, good morning, everyone. Thanks for joining in on Monday morning, the start of a new year. And on behalf of Motilal Oswal, I wish you all a very happy new year, happy, safe, and prosperous 2021. Hope this year brings much more joy to our families, and hopefully the market, what it has done in 2020, uh, we should see much better times ahead in 2021. And I will show you few slides, and I'll take you through of some of my pointers of what happened in 2020, why it happened, and what we feel can happen in 2021. And towards the end, I will leave you with some around 10 ideas that one can look for investing and in the for the year 2021, as well as most of these ideas would also fit for your long-term investment. I will just turn off the video so that the audio quality is much better. Has been marked as a year of a wide-ranging impact. Uh, if you look at what happened at the end of the year, the 2021 not into story, uh, you see that there are some countries where the markets have gone up by 20-30%, and in the middle there is bulk of these large countries: US, Japan, India. The emerging markets have given return about 15%, and then you have a clutch of countries in the European Union, UK, France, which have actually given negative return. But if you look at the left side, and the companies, the countries which have given good returns, in 2020. So if you see, initially we saw the market falling sharply, but from the bottom, the markets sharply. So while for the year, say from 1st Jan to 31st December, we had a 15% return, but from the bottom of the market has moved up by almost, you can say, for the US it was around 80%, for Nasdaq 65% for Dow Jones and S&P 500, for the Nifty and Sensex it was up 70-80%. That kind of bounce we have seen in the market. So we started the year on a high in Jan. We touched a new high, and from there, after the coronavirus spread globally, it became a pandemic impact, and created unprecedented lockdown. So the first time we saw a global lockdown kind of event, which which led to market falling, because if the economy is closed, nothing is profits will not be generated, business will not be done, and your profits will get impacted, and hence the valuation started correcting. And at that point in time, no one was clear as to how long this virus impact could be there and how long the lockdowns will be affected. Somewhere of the opinion, 6 months, 9 months, 1 year, maybe multiple years. We didn't knew, and that was the kind of concern of fear. From there, we saw unprecedented recovery, and response from the government, from central banks was unprecedented. We had the global interest rates being cut down to almost near zero, which was not done even at the Lehman crisis. The US, for the first time ever, cut the rate to near zero. Then the government announced packages globally. Then some of the large economies announced about 10, 15, 20% of their GDP as a stimulus package, while central banks globally have been pumping in liquidity through their bond buying programs at a very low cost. So that led to a flush of liquidity. That apart, the biggest change was that from lockdown to unlock happened very quickly, very swiftly. Both in India and globally, we saw the governments realizing that lockdown is not helping the cause, at least the economic cause, because at one side you were trying to give a stimulus for which you need revenue, and for that you need businesses to run. So realizing that, they started the unlock phase from June onwards. So the biggest impact was there in the first quarter, and from second quarter, June onwards, we saw the recovery playing out in the economy. With that, markets also started doing well, and as I told you, Indian equities rebounded almost 80% from their bottom and are now touching new highs. A year again of sharp volatility. We saw volatility inching up to almost 80 levels, and from there cooling off. And still now, if you look at the market, volatility index is closer to about 20 levels. In a normal period, we would have always seen VIX at about 14, 15 levels, but now that 20 level has become a kind of normal for the market. So what happened to the market in again, as I said, the numbers, the broad numbers do not show the true picture. Nifty and Sensex gave about 15% returns for the full year. What did well was the mid cap and the small caps. They sharply outperformed the large, and they mostly participated in the recovery. After 3 years of underperforming the large caps, mid caps have started performing well, and they are expected to continue to do well. What in terms of sectors, what did well in response to the pandemic? The defensive started doing well. Pharma, after 5 years, performed exceptionally well. It returned almost 60%. IT, which was expected to, which was again a laggard for quite some time, started benefiting out of the work from home, the shift to digital, the focus on technology as a key support during this lockdown phase. And we saw huge order inflows coming in for IT companies that helped IT as a pack doing well. Consumer is something which we all know, sitting at home, the way we were buying consumer FMCG goods, that did well. What did not do well is, after almost 4 or 5 years of sharp outperformance, banking and financials saw a big impact, mainly on back of the fear of rising in the NPAs, as companies, or especially in the SME segment, were shut down, closed due to the lockdown. They were unable to do business and unable to repay their loans. So that led to increasing in NPAs in the interim, and that led to profit booking, or you can say risk awareness from the banking segment. So in terms of Nifty, similar trend. What did well from the pharma space? You can see the top gainers: Divi's, Dr. Reddy's, Cipla, and then the IT pack: Infosys, HCL Tech, Wipro, some consumer names, Asian Paints, and then again you have the pharma and IT pack. What did not do well? A lot of PSUs were hammered. Some of the banking stocks you can see there, which were the key laggards. In terms of the institutional activity, again, it started on the somber note, but in the month of March, we saw FIs reporting a record selling, almost more than 60,000 crores of selling in a month, which was never heard of. So it was a record selling in a month on back of the fear of the pandemic. And from there, we have seen a sharp recovery in FI inflows. For the full year, they have bought 1.7 lakh crore, that is almost 25 billion, which is a record in a year. India was one of the preferred destinations in the emerging markets to receive foreign inflows at such record pace. We have seen 2 months back-to-back, November and December, of more than 60,000 crores of FI investments, which is again a record pace for 2 months in a row. We have never seen that kind of a flow, and the flows are continuing even as we speak in Jan, which is a good thing and is very positive for markets like India. Another positive macro factor we got is the GST collection in December, highest ever, all-time high GST collection of 1.15 lakh crore. Since the GST regime was launched, we have not seen this kind of number, and this is the 4th consecutive month that we have seen that the collection has grown comfortably on a Y-on-Y basis, which shows as a clear sign that the recovery in the economy is not just momental, but it's a structural recovery that we are seeing in the economy. You can see a lot of other macro data points, or even, say, for example, the e-way bills, the auto monthly sales data. So a lot of doubts were raised that October, November, the festive season has helped the demand, but even after that, so the December, when there was hardly any festive season, the auto sales have been pretty strong. The economic activity that we track has been pretty strong post festive season as well. So real GDP on the macro front, we saw, as I told you, first quarter was the biggest impact. We fell almost 24% in terms of the GDP number, and from there sequentially we have seen sharp improving. The GDP declined about 7.5% in second quarter. This was much better than the 24% contraction seen in first quarter. And the good part is, as of the third quarter, India is no more the worst affected major economy in the world. Some of the countries like Philippines, UK, Mexico are reporting even sharper declines on a Y-on-Y basis. So we are done better off compared to a lot of emerging markets. The unlock phase has been pretty quick. Economic activity has rebounded. The demand has been pretty strong, which is supporting the economic activity. On back of that, Forex reserve again at record highs. We have seen the accretion of reserves for the 8th consecutive month in a row. So we have the data for November. December data is not yet out, so that will be out in some couple of days. But for CY20 so far, 118 billion of reserve accretion has happened, and we are sitting at a Forex reserve of 575 billion, which is a record high. One of the key focus area for 2020 has been the rural segment, not only from the benefit from the government side, but also in terms of the monsoon, the harvest, the rural income, and lot of support from the government plans. Say, for example, during the lockdown phase, The Manrega plan was more focused towards the rural segment. Another bigger factor was the migrant laborers which went back to their roots, to their villages. They helped push the demand from the rural economy. And then you have the government's Atmanirbhar plan, where rural remains a key focus area. The spending for the rural employment generation has been a key focus area, and this is the space which is leading the growth in the consumerism. While the urban areas are already consumerized, we are seeing that the rural areas are now moving from the essentials to the higher end of the consumer basket, and that is where a lot of you see that the tractor sales has been pretty strong, one of the strongest growth we have seen in last couple of years in the tractors, farm automation segment, a lot of other space which have done well on back of the rural strong demand. So we saw second quarter earnings. We just closed the third quarter, so the third quarter earnings will come in a couple of days with the IT patch starting off. But Q2 we saw the earnings coming back to saddle. As I told you earlier, the road to normalization gathered steam from June onwards. India transitioned from localized lockdowns to widespread opening up, and where even before the festive season, very few sectors were put under restriction. Now almost all industries, sectors, segments have been opened up. So what we saw in the second quarter is that sales declined just 8% from a 30% decline that we saw in Q1. But the big surprise was the change in EBITDA. EBITDA rose sharply from a -3% to growth of 13%, and this was largely led by expansion in margins. Companies cut costs drastically, made business processes efficient, so that the margins, so that the losses are lower, and that led to a sharp growth in the net profit. From a 25% decline, we saw almost 26% growth in net profit. This was for our coverage stocks, and this is for the Nifty 50 companies, and it's a similar trend. We saw a 7% decline in sales at 24% growth in PAT. So what it has helped is that it is making business efficient. The companies are innovating to reduce cost and to increase business, and that is helping. So that has led to the first time in many years earnings upgrade. We have seen last couple of years that there has been always a earnings downgrade cycle. This is the first time we are seeing the street or the consensus doing a upgrade to their estimates for the current financial year. So let's finally look at what has happened to the valuation. So after that sharp run up, market valuation in terms of market cap to GDP, it had fallen from about 75-80% to 56, which was kind of lowest in the global financial crisis we have seen in 2008 FY9. But from there, with the market recovery, this market cap to GDP is now at about 91%, which is higher than the average, long-term average of about 77-80%. So that's what it is in terms of the market cap to GDP. Although it's not at its peak, post the pre 2008 Lehman crisis peak was almost 150% market cap to GDP, which we had seen in December of 2007. From there it fell, and then we saw again with the market seeing a sharp recovery, it went to as high as 95%. That is end of the year. Intra-year it must be even higher. So we are no longer cheap in terms of valuation. That's for sure. Is there room for further upside? Yes. How much room? There is a limited room for upside, and why that limited room for upside is because the earning cycle is on a recovery. Unlike the previous cycle in 2000, before 2004 to 2008, the earnings were growing at a faster pace, and we had reached an earnings plateau in 2007. From there, we saw the earnings declining cycle. However, this time the earnings have not grown for last 4 5 years, and we are seeing first year of earnings normalization. And next year we are expecting a sharp recovery or growth in the earnings. That's the biggest difference which can support. Suddenly, when you see that earnings grow, your when we say, suppose for example, we do a PE, it is a price to earnings. So if your earnings from 100 say becomes 120, suddenly your PE starts looking lower. So that kind of growth is there, liquidity support, earning support is there, the support from the government, RBI is there. So these things are likely to help the economy and corporates report a stronger growth. Similar case in terms of the price to earnings and price to book on a 12-month forward basis. PE is at 21 times, which is a premium of almost 20% versus the long period average. So we are no longer cheap. We are above long period average. Is there room for further upside? Yes. Before the fall, we were about 24, 25 times, which was a steep, you can say a kind of highest level which we had seen even in the earlier bull cycle. A 24, 25 times forward price to earnings was kind of a peak that we have seen, which has again acted as a peak. So there is still some room for upside in terms of index. In the price to book, similar case where we have moved up. It's a 6% premium to historical average of 2.6 times. We are currently at 2.8 times. So in terms of Nifty, the large caps, there is a limited room for upside. Hence, there is a lot of action we have already started seeing in the mid and small cap companies. So now finally coming to the core part of the presentation, what is the outlook for 2021 and what are the top investment ideas? So as we enter 2021, markets are already at all-time highs. However, this is in line with the improving data points as already highlighted and positive corporate commentary. The management commentaries post Q2 results and some of the commentaries that have been coming during the festive season. As I said, post festive season also, the demand has been pretty strong. Some of them companies have almost reached back to 100% utilization. The Atmanirbhar plan, the production link incentive plan, the government's focus to bring a lot of manufacturing activity into India is helping. A lot of companies have applied under the PLI scheme, are doing capex and increasing capacity. So the market resilience is mainly on back of the abundant liquidity. We can't deny that. Yes, I've showed you the FII inflows. Positive developments on the vaccine front. Globally, there are several vaccines which have got approved. India also has access to some of these global vaccines. Apart from that, we have our own in-house, or we can say in-country developed vaccines which got approval, the Bharat vaccine, and so we got 2 vaccines approval over the weekend, which are made specially, the researched and made in India, which will be used for the Indian people as well as exported to some of the other friendly countries. And finally, the signs of economic recovery. More importantly, at least in India, we have seen the cases seeing a meaningful decline. This was the case globally as well, but there has been a risk of a second wave of virus, which has in a muted form of the virus, which is spreading fast in the Europe. And over the weekend, we also got the news that US is again witnessing increasing in virus cases. So that's a big risk to the markets, to the economy going forward. However, we feel that economic activity will continue its recovery, and it could lead to a earnings upgrade cycle. While for FY21, the Nifty earnings is expected to remain flattish to marginal growth, we are expecting a sharp rebound in FY22, and further liquidity flows as central banks continue to remain accommodative, keep interest rates near zero. We'll continue to see liquidity flowing through into emerging markets, and that bodes well or good for the Indian markets. However, as I said, that there is a risk of second wave of COVID-19, which holds the sustenance of the economic recovery as a key. If something were to go very worse, and if we were to go down again to some kind of restriction in the economic activity movement or kind of localized lockdown, it could derail the growth that we are seeing, and that is a big risk. So for the year, the key triggers right now is the December quarterly results, which will start from next week, and the union budget, which is will be around first Feb. Some of the key events. The government has already been talking about making the 2021 budget as a watershed budget, which could push the economic growth further. We'll have to wait and watch what kind of budget the government presents and what kind of reforms that they are able to uh, formulate. But it could be a big trigger for the market going forward. December quarterly numbers are expected to be much better due to the festive season demand, as well as the demand sustenance of demand post festive season. We've seen from a lot of data points, a lot of management commentaries, that demand has been pretty strong. So overall, the structure of the market remains positive. However, there could be intermittent correction as the valuation have moved up, and there are risks of these negative news flows. But these would be opportunities. Any sharp correction would be an opportunity to buy good quality stocks, and hence the strategy would be to accumulate, to list down your list of preferred stocks and to buy them on dips. We will get opportunities in the market, and it will also help you stagger your investment and average out your investment. In terms of sectors, right, what we are positive, we continue to remain positive on IT, healthcare, telecom, uh, consumer names, some of the FMCG stocks, select auto, and financials. So finally, I leave you with the top investment ideas that we feel one can look for from a 2021 for the year, as well as from a long-term investment perspective. In the large cap, from the IT space, we like Infosys, it's a preferred pick. FMCG, we like HUL. The banking, we like ICICI Bank. From the telecom space, Bharti Airtel. One can also play telecom through the Reliance Jio through Reliance Industries. Then in the pharma space, we like Divi's, and from the auto space, we like Hero Moto. Some of the mid caps that we like is IPCA from the pharma space, AU Small Finance Bank, Emphasis again from the IT space, Crompton Consumer, not an FMCG space, but it's more from the consumer durable space, and ICICI Securities, which is again a play on the financialization, increasing penetration of the equity broking business. So that's all from my side. Wish you everyone a very happy and prosperous 2021. Uh, Now we can take questions. I request everyone to please put in your questions in the Q&A segment, and I will take them one by one. So the first question is from Vishwas. He's asking for 8 to 10 stocks for long-term investment. Vishwas, this is the slide you can see. This is These are our top picks. Apart from that, we keep coming up with ideas, reports, strategy notes, where you will find our top picks. So we come out with the strategy or the top picks on a monthly basis, where we reiterate some of the calls. Sri Devi also here has a question, which 3 to 4 years. Some of these stocks I can buy and hold, invest for 5 years also, 10 years also. When the investment duration increases, we tend to stick to more known names, large cap names as a preferred picks. So the names given here are mostly stocks which we can buy for 3 to 4 years. So someone has asked, please show the slide once again of the suggested picks. Yes, this is the slide I have kept open. Hope that helps. Uh, Rajesh has a question. With the economy on the positive growth path, which banks, IT, and pharma companies do you expect to see long-term upswing? So yes, so these are just few picks that we have highlighted. You will find a lot of other banks which are doing very well. You have HDFC Bank, which is a consistent performer. Kotak has been a consistent performer. Within the PSU space, we like SBI more from a recovery play. Plus, you have the subsidiaries which are doing very well for SBI. You have the SBI Life, you have the SBI Mutual Fund, you have the uh, some of these other SBI subsidiaries which are, so now the SBI cards is also listed. So that gives a kind of a margin of safety to the valuation. So that itself, the valuation of subsidiary itself is about 160, 180 rupees, and we are seeing that the stock had down to free. The bank was actually available for free of cost, and that is where with the economic recovery, we see that stock also doing well. Similarly, IT, I've listed down Infosys, but you can, so TCS is the best pick. It always trades at a premium valuation. Hence, it's very difficult to recommend. Infosys is doing much better, reporting much better growth in the last few quarters, but is trading at a good steep discount to TCS, and hence we prefer that. Similar is the case with HCL Tech. One can look at that stock as well from the IT space. Pharma, yes. So pharma, we believe that the growth path for pharma is just opened up. There is a long runway of growth ahead for pharma. So we believe that the next 3-4 years could be, the pharma stocks could see a strong growth, and I will point out the reasons. The first and foremost is post the pandemic, the focus on healthcare has increased drastically. Not only as an individual, we are taking started taking more care of our health, but the governments have also realized that the spend on healthcare needs to increase as a key factor. So if you see what will happen is, in the whenever the election comes, the focus will shift from infrastructure or from the other growth to providing a good health care, and that will lead to a higher spending from the government, and they will be the procurement of medicines, the procurement of other things will increase. So institutional demand will go up. In US, Joe Biden has come back as a president, and he was the vice president at the time of the President Obama. And Obama, you remember that he had a very big focus on healthcare. So we had something called as an Obamacare bill, which Joe Biden has said that he will bring back in a newer format. So US has been a key market for a lot of pharma companies in India. The demand had come down, that led to pricing pressure, which is already eased off and is likely to improve. So pricing pressure goes off, you can price your products better, your realizations, profitability increases, and because of focus on healthcare, the USDA structural changes happened, that from being very strict last few years, they have become very accommodative. They have started giving a lot of approvals. The US FDA, we have seen that from April, May, June, we started seeing a lot of approvals from the Indian pharma companies, be it products, be it plants, and these are plants and products which are not related to COVID, because that time the vaccine was not there. These are the pending plants, pending products, and these new plants and products are going to provide the additional growth for these companies. So it's a long runway of growth for pharma companies going forward. So most of the pharma companies have done well, be it large cap, be it small cap. Some of the names that we like are Dr. Reddy's, Lupin, Sun Pharma from the large cap space. We like Ipca from the mid cap, Alchem Labs from the mid cap space. Then you have PI Industries, which is a agro cum pharma CRAMS business, which is done very well and is likely to continue to do well. So Gaurav here has a question on which sectors should do well in 2021. See, apart from the major themes that I have listed down already, some of the emerging themes that can do well in 2021 is one is you see a lot of focus on home improvement. With people spending more time at home. We saw people spending a lot on a lot of consumer durables. So be it your microwave, oven, washing machine, dishwashers, vacuum cleaners, TV, music systems. What they have also started doing is in making the home look better, brighter. So you saw spending on some of the tiles, cement. They have started doing well as a buyers and able companies, fans, so Havel, Crompton Consumer. They have started doing well. Uh, Another big theme is the digital theme, where focus has moved away from your traditional media to a digital platform. So a lot of mobile-based companies, internet-based companies have done well. So be it an Info Edge, India Mart, Affle, Root Mobile. So this is another emerging theme which is coming up in a big way. Then you have the specialty chemicals, which is basically just so pharma and specialty chemicals I can put together, which is also doing well because of the global China plus one strategy. What does this mean is that companies which are sourcing their raw materials from China want to de-risk and have an additional source of their supply chain, and that is why they are saying that China plus one strategy. Basically, you have to develop more supply chains where India is figuring prominently, and a lot of so you hear the corporates in the specialty chemical space, be it SRF, Navin Fluorine, the RT Industries, they are all doing capacity expansion on back of the expected order inflows that they are expecting over the years. So view on construction and cement sector, both we expect to do better. Construction to some extent, we don't have a lot of good companies. The biggest company is L&T, which has already started doing well. The question was of the order book and order inflows, which is still not growing at a much faster pace, but there is some visibility in terms of order. Cement, I generally, in a lot of my talks, I generally say that it's like a mini FMCG company in India. If you see a longer term trend, say a 10-year, 15-year, 20-year trend in India, cement has shown, if you take the entire cement production of sales in India, they have shown a consistent growth, and be it a good year, bad year. So some years the growth dips, some years growth is much higher, but on an average they give a 7 to 8% annualized growth in terms of production and sales. Then companies, there are a lot of companies which have done much bigger capex plans, and they have grown much faster. So in the current environment, we are seeing increasing trends. So last few months, the spending from the government on infrastructure has increased drastically in order to create employment in the rural side, Manrega. So a lot of activities have happened, and that has led to infrastructure development has happened, and that has led to growth in the cement patch. However, if you look at the demand pie, almost 50 to 60% demand for cement comes from housing, and that is that is also indicative of some of the states lowering the rates. You can say the GST and the other taxes on stamp duty taxes on real estate. So, for example, Maharashtra has lowered it from 5% to 2% and 3%. That is giving an impetus for home buyers, and that will lead to increasing construction activity, and that should do well. So in cement, we like Ultratech, which is the largest company and our preferred pick. We have JK Cement as a preferred pick. Other stocks that are good, so a lot of large cap are Cement, Ramco, are doing well, and ACC and Ambuja. So ACC is a kind of a value stock which is doing well. India Cement, so Sayyed here is asking, thanks for the session. Where can I on our other social media handles? Which other stocks? Prakash here has a question on key stocks of mid-term investment in auto sector. Is Motherson Sumi a viable investment? Yes, Prakash, uh, growth in the past they had 5 years and to sharply improve not only the profitability but also return ratios, the capital allocation, and the only thing is they're a lot more dependent on the European market, which has suffered the most in the current pandemic, and hence a recovery there will lead to better numbers for Motherson. But as a stock, we like that. Some of the other uh, mid cap mid cap stocks that we like, I'll tell you. So Endurance is another mid cap auto name that we like. Then we have some of the players. Balcony Industries is something that one can look at. In the auto batteries, one can look at Raja, which we like. So there's a question on, please give some more mid caps from IT, pharma, and FMCG names. Sure. So from IT, we like given one name emphasis. Uh, in I'll tell you. In terms of pharma, I have already shared a lot of mid cap names that we like. So, for example, I'll tell you from pharma, the mid cap names, Oro Pharma, one can look at. Then Granules, Ipca, Jubilant Life, Laurus Labs, uh, Strides Pharma. So these are some of the names in the mid cap pharma space that one can look at. And Mindtree, Emphasis, Coforge, Persistent. These are some of the names that one can consider. And FMCG. So, okay, FMCG mid cap names. FM, most of the stocks are well and generally do well. But in terms of mid cap, so Tata Consumer is no longer a mid cap, but that is our preferred pick for last couple of years. It has done really well. Dabur, Marico, Nestle, Pidilite, Godrej Consumer. These are some of the Colgate. So these are not purely mid cap, but these are not the so HUL, Britannia, Asian Paints. These are the larger peers, and these are the mid-size peers that we like. So Rajesh here has a question: with valuations having run up so high, what should we our investment strategy? A very good question, Rajesh. So if you look at the generally in the market, we have a you, I would not want to say the burn, but you can say a way of growth, up early, and then we start seeing economy, the companies start bringing numbers, and more valuation come basically. So you have the is already there, and you have the earnings grow at a much faster pace over, and to catch up, and when that happens, when it improves, you generally tend to get much higher valuation. When a company is growing at 5%, it's a very low valuation. But when a company is growing at 20%, you give a much higher valuation. You don't say that I will continue. So the question again, I say that what should be the strategy? As I said in my slide, the strategy should be that adopt, so make a list of good 10-15 stocks that you want to buy, and keep adding them on a regular basis. Wait for days like last week we had a Monday when the market had fallen about 4-5% in a single day. Those kind of days are good days to buy or accurate stocks. So you rightly said, yes, markets have run up, and hence there will be intermittent corrections. 5%, 10%, 15%, 20%, it can happen, and that will be, we will, nobody can say what is the reason of the market fall. Once that happens, everybody will come and say that this is the reason why market has fallen. So for example, in Jan 2020, if you would have done this session, and if you have to ask me the key risk for the market, there were several other risks. 2020 was the US-China trade war, and that something new like a coronavirus pandemic has played out, which nobody had put in as a variable, as a risk. Something out of the blue came in, did the impact. So what will happen or what can cause a risk, we'll not know, but there will be a lot of issues, a lot of impacts on the market. But if you look at the equities in a longer moment, we had the Greece, we had the Brexit, which is finally culminated, and still the markets, global markets are all-time high. So equity market will not move in a single direction. We will have ups and downs. So the good part is we are starting and good economic growth couple of years, be it globally induced, be it locally induced. So we had the GST implementation, which impacted, we had the demonetization, which impacted the economy, and then we had a lot of other several factors. But things have moved much better from there. So economic growth cycle is just started, earnings growth cycle is just started. So we could see a good so valuation can remain higher for a longer period if the earnings growth keeps pick up. Hope that answers your question. Vishwas here has a question: do Motilal Oswal have a model portfolio? Yes, we do have a model portfolio. We have if you log into our website, and under the advice section we have basket. So we a basket execution, one single click execution basket. You can select the basket, the amount will come, how much you need to invest for one basket, and you can simply execute online. Any changes you will get through notifications that these are the changes in the model portfolio. We also release the multi-cap update on a monthly basis. Sumit Das here has a question on Davies, which has already been a multi-bagger. Yes, Sumit, as I said, the core is that if are the earnings growing? If the earnings keep growing, the pace of the larger the company becomes, the pace of growth definitely comes down, and the pace of, you can say, at which the stock has given return will also come down. It may not deliver the kind of return it has given in the past, but definitely it is one of the best stocks in the pharma space. A kind of consistent growth, consistent compounder kind of a stock in the pharma space. Pick is HUL and space. We like PI Industries. Another Burger King look at the stock. Both are both Hello guys, sorry, there was some network issue and I got disconnected. I'll take a couple of questions before we round up for the day. There's some questions on Facebook Live. First is, how much correction do you see in the near term, 3 to 6 months? Generally, the way we are looking at the market right now, there could be a correction of 5 to 10%. But as I said, it all depends upon the development that has happened. The negative news which will induce these kind of fall can lead to at max we see a downside of about 20%, not more than that in the index. But on a normal basis, a 5 to 10% correction brings in a lot of investors who are still waiting on the sidelines to come and start investing, and that helps support the market. DVs I've already answered. Future of Indian Railways, particularly on construction stocks like RVNL. Uh, in terms of overall railway business, we like the space. It's a good segment where the government spending keeps happening irrespective of the financials of railways. Uh, Although we don't have coverage on stocks in the railway space, but some of the railway related stocks have good financials. IRCTC again is a play on the internet scheme of things in the travel business. It has done really well. It can do further well once privatization of running of railways picks up. If they have already started few of the train services, but because of lockdown, things got stalled. But now things will again, once things become normal, that can pick up. The specific question on RVNL, we don't cover the stock, although the stock looks good. So final question I'm taking, whether to hold Reliance Industries for FY21. Yes, that's a stock we believe can do well. It has done phenomenally well in 2020, more than doubled. The key triggers here are one, the retail business, and two, the geo business. Plus, what we are seeing is that in the core oil and gas business, things are improving after a couple of years of underperformance, and that could really change the entire dynamics. Key triggers in future is one, uh, the unlocking of the retail business and the geo platforms. Whenever that happens, they have taken a lot of investors in the geo platform business. So in 2 years, 3 years, 4 years time, they will have to unlock that, get it separately listed, and that can lead to significant unlocking of value. So yes, the upside could be limited. We have a target price of about 2,400. So you can say from current levels, we have about 15-20% upside for the current year. So yes, you can hold on for that. So with that, we are now almost more than up with our time limit for the session. Thank you everyone for joining us today, and wish you all a very happy, safe and prosperous 2021. Thank you.